Right, sir. Okay, we'll start you. So, good afternoon, friends. On behalf of RBSA family, I welcome you all and thanks for taking your time to attend the session. My name is Chetan Khandaria. I am a due diligence professional and I have been performing this due diligence for last 25 years. I am a chartered accountant by profession and I am a yoga student and a yoga instructor. But of course, the passion is not because of the current situation, but I have been practicing for many years. I recently got associated with RBSA, it's very recent, sometime in December 2019, and had the diligence practice. The prevailing situation is very serious. There has been major disruption. There has been a lot of uncertainty, fear, anxiety on a mass scale and in a different form. Again, on a lighter side, fear and anxiety is something which otherwise also we always carry with us. But there has been huge health impact, economy impact, business impact, people impact, and also capital impact. Now, serious liquidity issue which has been there, cash conservation has become a new mantra. At the same time, there is also a need for new capital. But what remains common in all the situation that cash is always the king. There is a time we all need to move on and bounce back. There has to be a new beginning. So the businesses need to be restructured. The business growth is required. It could be organic, inorganic, the M&A. Fundraising is required. It could be equity, preference, debentures, or any other forms, but of course with a good structure in place. There needs to be effective use of capital, buyback, delisting, dividend, or preserve shareholders or other stakeholders' value. So there are various aspects which are required, which are there. And if you take recent examples, Reliance Jio has been a classic example. They raised USD 11 billion from 6 investors, and they also they raised about 7-8 billion from the existing shareholders by a right issue. We have delisting announcement by Vedanta. We have Delta Corp and Dalmia who are coming up with the right issue. So people have started moving on and started evaluating various options and structures for growth. And of course, of this, the tax and regulatory aspects play a very important role. So, my dear friends, today's session will focus on the tax and regulatory solutions, may it be business restructuring, enhancement of shareholders' value, increasing in promoter holding, fundraising, M&A deals, etc., etc. Ravi Mehta, my colleague, he will take this session, which is called business structuring under new normal. Of course, we have been colleagues for many years. We know each other for many years. We came from the same school. I was then a senior to him by 4 years. Like me, diligence, Ravi has been a transaction tax professional for more than 2 decades, and he's a chartered accountant by profession. Ravi recently got associated with RBSA. He came after 2 months when I joined in February 2020, and he heads the transaction tax practice. So we'll have a presentation from Ravi. And if time permits, we'll also have Q&A session. This session would basically touch upon the technical aspects, and I'm sure you will find this session very enriching. So Ravi, I just hand over to you. Thank you.
Thank you, Chetan, for your kind introduction. Very good afternoon, friends. So as Chetan mentioned, despite trying times, corporate India is constantly endeavoring to see how they can preserve their shareholders' value or how they can collect some growth or use their surpluses to improve promoter stake and control in the company. The examples that he cited of Reliance Industries, Bharti, Dalmia, Delta, Vedanta are absolutely noteworthy. All these companies are achieving their end objectives by using different tools that are available under the Indian law. So through this session, we have attempted to visit some of the key procedures and solutions that are relevant in today's circumstances. To begin with, what we are looking to do is we will focus on the liquidity management, where we will discuss the long and short procedures available under the law to move cash from one entity to another. We will then cover some of the select avenues of fundraise other than equity that are available under the law. And finally, we will touch upon certain aspects of stake enhancement and control in a listed company that are typically available to the promoters. So, but before I commence the session, there are two caveats for the listeners. The first being that what we are discussing today are select situations and solutions, and it's not a comprehensive list. And secondly, what we are covering today are high-level insights for knowledge only. Hence, seeking a professional guidance from subject matter experts would be critical before you look to implement them. So with that, we move to the first topic of discussion, which is liquidity management. So we all appreciate that COVID-19 crisis has impacted almost every business, with mainly as Chetan mentioned, cash management now becoming the new mantra. Hence, it wouldn't be unusual that most of the businesses, whether local or multinational, would be looking for ways and means to collect and preserve cash. So in a business group with more than one entity, there is a possibility that surplus cash may be available in one entity, but may be required in the other. Various scenarios may exist, and our laws allow both expeditious as well as longer procedures to facilitate fund movement between entities. So some of these situations which we look to cover today are, say, groups where cash exists in one pocket, which may be, say, subsidiary or a step down, and is needed in another, which may be, say, a parent or another sister concern. Likewise, there could be also a situation of cash available in parent and needed in subsidiaries. So we first start with the shorter procedures. Take the first situation where we have cash available in the subsidiary and it is needed in the parent. Now, this would be a typical story of captive companies where the parent may be compensating them on a risk-free basis with a cost plus return. All the risk may largely reside in the parent. Under the current crisis, they will be in need for more cash than ever. So there are two mechanisms available under the law to upstream this cash. So typically, as is used, one is could be in form of dividends, and other could be in form of share buyback. Now, both the procedures are that way relatively easier and quicker to implement. The reason being that none of these procedures involve any clearances from external authorities. However, there are rules that govern each of these distributions. So take the case of dividend. A company can distribute dividends as many times as they want during the year, up to 100% of their current year's distributable profits. Now, the mandatory transfer to general reserve, which was a requirement under the earlier law, the 56 Companies Act, has now been done away with under the current company law. So take the case that if company doesn't have, say, current year's profits, then it can still make use of their past reserves. However, there are limits set under the law up to which you can distribute dividends. So a company cannot distribute dividends exceeding 10% of its free net worth from its past reserves. And while doing this, they also need to ensure that whatever are the balance reserves left, they at least constitute 15% of its paid up capital. Typically, like everyone might be knowing that a dividend doesn't result in any marginalization of shares, and a share premium account cannot be used for distributing dividends. With respect to taxation, the government has reinstated the earlier dividend tax regime from this year. This means the incidence of dividend tax is now on the shareholder and not the company. For a foreign shareholder, he can now avail the treaty benefits as well as claim tax credits in his home country vis-a-vis such dividends. And even say if he is not having any treaty benefits, still the applicable rate under domestic law for non-residents would only be about 23%. So this rate may still be lower than the taxes that are applicable to Indian shareholders, which typically range up to 35%. Now, on the other hand, if I were to talk about buyback, the distribution limit in case of a buyback is pegged under the law at 25% of the last audited net worth of the company. This limit is applicable to both listed as well as unlisted companies. Share buyback is governed by several conditions under company law as well as share buyback regulations. The share buyback regulations allow a listed company to undertake its buyback using any of the three mechanisms. So this could be number one, say through a tender offer, or number two, by an open purchased over stock exchange, or say through book building mechanism. Now, one has to note that the promoters of listed companies cannot participate in open market mechanisms. So some of the other key restrictions in buyback, if I were to recite, the first is that there has to be a gap of at least 1 year between two buybacks. This is something absolutely mandatory. Secondly, any share that is bought back cannot be reissued for at least 6 months by the company post the buyback. In fact, the SEBI regulations under the normal course require a listed company to at least adhere to a time gap of 1 year before they can reissue the same security. Having said that, this cap has momentarily been relaxed for 6 months by SEBI through a recent notification, and this relaxation is up to 31st December 2020. This is primarily keeping in consideration the ongoing crisis. So as to say, if I were to just exemplify, say if a listed company has undertaken equity buyback in say October 19, then it can make again fresh equity allotment anytime post May 2020. The other aspects are that the share capital of the company basically gets reduced post the buyback, as the law requires such shares to be compulsorily cancelled within 7 days. And a company can undertake buyback using three of its resources. One can be its free reserves, or it can be its free, or it can be share premium, or it can also be the proceeds from issue of other class of shares. So any one of the mechanisms can be used to make a buyback, unlike dividends where your room is only for free reserves. In terms of taxes, the buyback regime basically governs every buyback, whether it's done by a listed company or an unlisted company. And under such regime, the incidence of taxation is on the distributing company, and which is about 23% of the distributed income. So such distribution is determined by reducing on the original issue of such shares. And under FEMA, if there are, sorry, I'll first finish the tax aspect. So since this is a regime similar to your earlier dividend distribution tax regime, so the income is exempt in the hands of the shareholders. And since this buyback income is tax exempt, claiming resident is different to any type of normal sale to the resident, and FDI pricing would definitely be applicable. So we now move to the next situation, is movement of funds from a step down sub to the parent. As depicted on the picture on the left, we have cash sitting in the step down subsidiary, but is needed by the ultimate parent. Now, there are two ways in which such cash can be upstreamed to the parent. The first is the dividend route, as depicted. Hello. So basically, one is the dividend route, what is depicted in the right side of the structure. You basically see that a step down subsidiary distributes dividend, which is sub 1, and then sub 1 distributes the dividend to the parent. Now, while the new dividend tax regime would apply to both sub 1 as well as the parent, the cascading effect of dual taxation on dividends get eliminated if sub 1 is eligible to claim tax deduction under section 80M. So for claiming this deduction, all that what sub 1 has to ensure is that it has paid the dividends to its parents at least 30 before its return filing deadline of the year of receipt. The section 1 benefit is available irrespective of the step down sub being Indian parent or a foreign subsidiary. And if we were to talk about the other route, which is depicted on the left side, it is the loan route. So in this, what happens is the step down subsidiary directly gives loan to the parent. Now, of course, if the step down subsidiary is a foreign sub, then eligibility under ECB regulations need to be duly examined first. However, the moot point here is the taxability of such loan under the deemed dividend provisions of 222E of ITA. Now, basis judicial precedents. Before going to precedents, I'll first just so what this 222E signifies is, it says that if there is a loan from a beneficial owner holding at least 10% stake in a investee company, then such loan by investee company to such owner basically classifies as dividends, deemed dividends. Now, in this case, if we see parent is the beneficial owner of the shares of the step down sub, but would therefore 222E apply? Now, basis certain judicial precedents, a view is definitely feasible that there should be no dividend implications in this case, because what the section envisages is a registered beneficial shareholder. While one may take a view, before taking the view, we would recommend that a detailed analysis and an expert opinion should be taken in order to examine the merits of the case. The next situation covers a case of sister concerns. So where both of them are commonly held by the parent. So if you look at the structure on the left, there is surplus sitting in one sister concern sub 1 and the need of cash in another, which is sub 2. Now the pricey option could be sub 1 can distribute dividends to parent, which in turn can invest in some instrument in sub 2. Now such modalities would definitely entail dividend tax leakage in the hands of the parent. An alternative, therefore, of this could be that sub 1 can directly invest in sub 2 through some instrument, and such instrument can be, say, preference share. Now, if such shares are redeemable, then sub 1 can also receive back the money without diluting its net worth and without having any material tax leakage. Now, one may ask that why not sub 1 give debt instead of preference shares? Well, a debt can also be a feasible option, but this can be pursued if sub 1 doesn't have accumulated reserves. So if sub 1 sub 1 has got reserves, then there should be there could be deemed dividend consequences on the transaction. So this slide reveals that could be a good alternative in select situations. So say a parent has got two subs, and one of the subs has surplus cash which is needed by the parent. Now, as an alternative to dividends, and of course subject to commercial justification, the parent can also explore selling shares of sub 2 to sub 1 at its fair value. Now, from a tax perspective, we can examine both the situations. That is, number one, if say sub 1 is say parent or now say if it is a situation where say it's a foreign parent, and say such parent is eligible to treaty benefits because say it is situated in country like Singapore, Mauritius, or Cyprus, and it is eligible to its treaty benefits, and say these investments in sub 2 had been made by them prior to March 17. So namely, these investments are grandfathered, then possibly this transaction can be completely tax exempt in the hands of the parent. So there is absolute tax neutrality to the transaction. Even if we have to take the case of parent not being eligible to any treaty benefits, still its effective tax rate on the capital gains would be only about 11%. This is the rate which is applicable under the domestic law, and this rate is still lower than the tax rate which is applicable on dividends. So needless to add that when a foreign parent is involved, there are FEMA aspects around pricing guidelines, limits, etc., as well as transfer pricing provisions, which needs to be duly factored. Now take the other case. Say on the other hand, if you have a parent which is an Indian company. Now, generally, such transaction would, become tax Indian company under the capital gain provisions. However, an exception can if parent is holding 100% stake in both the subsidiaries. In such a case, it can, basically avail the exemption under 47(4) for this transaction. Now, when somebody, has to avail a 47(4) exemption, they also have to be mindful that the shareholding continuity condition of Section 47A also becomes applicable. So Section 47A, if they were to be applied, this means effectively that in this case, parents holding in sub 1 and sub 1's holding in sub 2, they have to continue as it is for 8 subsequent years. So if at all there is any change during, this 8-year window, either at a parent level or at a, sub 1 level, it could trigger taxation in the year of, such change. Now, this is the last option in the expeditious chain. So this is a very common situation that prevails in most of the cases, and where basically parent has the money and is needed by the sub. This is honestly more of a theoretical discussion, but the law allows various modes of investments through which parent can, fund its subsidiary. So they can, use it could be either in form of equity, or it can be equity-oriented instruments like CCPS and CCDs, or it can be quasi-debt instruments like OCPS or OCDs, or it can be even pure debt, or pure debt-like instruments, which is NCPRS and NCDs. So I think the way all this issuance happens, so except for if it is a case of pure debt, any other instrument which a company looks to issue to raise cash, they can do it either through preferential allotment mechanism or the rights issue mechanism as given under the company law. Now, while listed companies are governed only by a listed investee company would have even SEBI regulations applicable. SEBI regulations could be, SEBI ICDR regulation, SEBI LODR regulations, or there can be SEBI non-convertible preferential regulations, or SEBI debt security regulations, etc. From a FEMA perspective, the classification is that while equity, CCPS, and CCD classify as FDI, the other instruments get classified as debt. And basically, each are governed by, FDI and, ECB regulations. So with that, we move to the next topic, which is liquidity management using longer procedures. Now, if we were to talk about longer procedures, typically, the typically used longer procedures for corporate and capital reorganization are scheme of capital reduction or scheme of merger demerger. Now, both are NCLT driven processes under Companies Act. There are various reasons for which a company may resort to capital reduction process. Under current circumstances, this process can become very handy if, say the company having cash doesn't have, sufficient free reserves, or the requirement is to, distribute cash beyond the limits of share buyback. Likewise, there can be several reasons for pursuing a merger demerger process. The typical ones, if I were to recite, could be consolidation, or achieving synergies or cost efficiencies, or focus on core, etc., etc. Now, I have not gone into explaining demerger in detail on this chart, because more or less the process and procedures ramifications are almost equal like a merger, except for select tax ramifications. So we will in this slide restrict ourselves to capital reduction and merger. So with respect to tax treatment, any benefit from capital reduction gets classified as dividends up to the accumulated reserves of the distributing companies, and any surplus over such reserves are capital gains. On the other hand, a merger demerger is generally tax neutral if certain conditions are satisfied. Now, this is both at a company level as well as at a shareholders level. Additionally, in a merger demerger, there is also a rollover of original tax basis and holding period in the hands of the company as well as the shareholders. Now, one distinct aspect between capital reduction and a merger, which might be also relevant under the current circumstances, is the ability to use the surplus cash of the company while this process is underway. So say if you are pursuing capital reduction to upstream cash, then a shareholder cannot enjoy this cash till the time this process is completed. However, if we say take the case of a merger, then there can be an immediate excess of cash between the two entities, which is feasible. And this is feasible by using use of capital instruments which can be invested in each other, or there can also be a case of debt which can be given to each other depending on the underlying facts. Now eventually what happens when the merger is when the merger becomes effective, all these cross holdings basically get cancelled. The next primarily is a very hot topic, which is on a cross-border merger. To be frank, we are looking to have a earmark specific section in this knowledge series to only focus on cross-border mergers. However, we are just touching some aspects of cross-border merger at a very high level in this session. So the company law, as most of you might be aware, the company law now allows cross-border mergers under Section 234 of the Companies Act. So what is basically this cross merger? In simplicity, if I were to say, it's a merger between two companies where either the transferor or the transferee is situated outside India. Now, if the transferor is a foreign company, then it's a case of an inbound merger. And if it's an Indian company, then it's a case of outbound merger. The Indian company has to basically make use of the procedures laid down under 230, 232 of the Companies Act, as also depicted in the picture on the right. Whereas as far as foreign companies is concerned, they have to adhere to the local merger regulations in their country of regulation, in their country of registration. Another aspect is the company law presently do not allow a cross-border merger. The language honestly do not allow any company to undertake cross-border demerger. And this particular aspect was also recently confirmed by NCLT while rejecting one of the applications of cross-border demerger of a pharma company. So while we talk about this cross-border merger, I may cite that there are several qualifying criterion which are laid down in the law for cross-border mergers. Secondly, there are several open areas under the law, including the one on taxes that surround cross-border merger. And all these merit a detailed examination before a process is undertaken. We are definitely looking to discuss many of these aspects in a earmarked session on cross-border merger. So with that, we come to the next topic of discussion, which is about select avenues of fundraise other than equity. So the first of this is fundraise through redeemable instruments like NCDs and NCPRS. Now, both are effective instruments for investment as well as fundraise in select situations. Both the instruments become handy, especially when an investor is looking for some assured return of recoupment in the event of a liquidation. The law also allows unlisted companies to selectively list these instruments on Indian Stock Exchange. When a company lists these instruments, number one, it provides better marketability to the investors, and number two, it is more it offers more efficient taxation when there's securities are when the securities change hands, so when they are divested. So while the company law and tax classifies a preference share as share capital and a debenture as a debt instrument, for FEMA purposes, both are classified as debt only and governed by FEMA debt regulations. SEBI has also come up with specific NCPRS and NCD regulations. If the securities have to be listed on stock exchange, and while there are several aspects around these two instruments which are given on the slide, which are absolutely self-explanatory, I will touch upon some of the key aspects which are around investments by non-residents in these instruments. So non-resident wishing to subscribe to such instruments, they can subscribe only through the channel of registered FPI. So if a non-resident is a registered FPI only, then it can subscribe. Or if they are NRIs or OCI, namely overseas citizens of India. Else, non-residents can invest in these instruments only through registered Indian AIF. Also, I think other condition is that any issuing company cannot issue more than 50% of its issue size to a single FPI. So in other words, an issuing company at least needs two unrelated FPIs to fully subscribe to its redeemable instrument issue. The only exception to this is the offers made to an FPI that are covered under voluntary retention route. Now, for your information, an FPI qualifies retention route if it commits to retain at least 75% of its funds invested in India for at least a period of 3 years. So if you have such FPI, then even a single FPI can become subscriber to your this redeemable instrument process. With respect to taxes, now any gains from transaction of securities over stock exchange attract capital gains at a discounted rate. So like any typical listed securities, it is 10% or 15%, depending on whether it's a long term or a short term, and of course that would be subject to applicability of STT. Also, the coupon which is attached to listed NCD, that is also eligible to concessional withholding tax in the hands of the non-resident. This is under select situations. So we then more to discuss another important aspect, which is issue of bonus listed NCDs and NCRPS. So basically, the law now allows an unlisted company to issue bonus NCD and bonus NCPRS by capitalizing its reserves. And these instruments can also be selectively listed on Indian Stock Exchange. So there is no need for the issuing company to also list its equity. They can only selectively list this NCD and NCPRS. Now, this can be an effective tool, especially in current times when company are looking to conserve cash. What a company can do is reward its shareholders with bonus NCPRS or bonus NCDs, and then list such instruments over the stock exchange to improve its marketability. However, it may be noted that when it comes to issue to non-resident shareholders, you can effect such issue only through NCLT scheme. So what we have also tried to put in this slide is a situation where how this listed instruments can also become useful tool for promoters to raise funds for its other businesses. So say a promoter has a company, so as is depicted on the extreme left, a promoter which has a company which has strong reserves and weak liquidity. The promoter also has other businesses where he needs to invest cash, and the part is that say these businesses also don't have much assets which he can leverage on. Now, promoter can do in this case is have his company with strong reserves capitalize some of these reserves by issuing bonus NCD and NC or NCPRS, as the case may be, through the scheme to all its shareholders. These bonus instruments are then listed on the stock exchange. Now, these instruments, like other shareholders, will also be received by the promoter, who can then divest it over the stock exchange to any interested investor, and the cash so realized can be then channelized into his other businesses. in terms of taxation, these securities are listed securities, there would be only 15% short-term capital gains tax plus STD, which would apply to this transaction. So in nutshell, what happens, in this case, you have the company with reserves who service the funds which are needed for your other businesses, and at the same time, promoter also gets the much needed liquidity in his hands. Expand those businesses. We now move to two very important tools which are available in the law for infrastructure and real estate sectors. So which is basically REIT INVIT. So infrastructure and real estate are two critical sectors of our country's growth trajectory. Unfortunately, they have been the most impacted by the ongoing pandemic. Both these sectors need a substantial flow of capital and also have a long gestation period. Given the paucity of bank funds available in these sectors, SEBI had introduced additional channels in form of real estate investment trust, or INVIT, which is infrastructure and investment trust, to support asset monetization in these sectors. Now, these concepts have been recognized as a useful tool for cash mobilization and investments in many parts of the world, and India too is also warming up to it. So some of the big names in the industry have already availed this channel, and there definitely should be many more in the pipeline wanting to exploit it. Now, some of the key USPs of this REIT INVIT framework, if I were to cite, so number one, the owners, it allows the owners to segregate their completed and operational project assets and monetize them to raise their funds. Now, these funds can provide this valuable capital to the real estate owners or infrastructure owners, which can be used for either their incomplete projects, or for repaying their high cost debt, or for also undertaking any other further expansions. Now, one major USP is that while the funds raised through REIT INVIT channel have an advantage, of almost being an equity, I would rather say, as far as the sponsor's risk or return goes, like for him, this is just like some investor investing in equity, like the way they invest in REIT INVIT units. But the yield expectations from the investor from REIT INVIT is almost like debt-like. So the expectation is from this kind of units, which is almost equivalent to any debt-like return which one could have expected from debt instruments in a company. Now, one other good part is that sponsors or owners, they don't have any obligations to redeem these units under REIT INVIT, and it only gets traded on stock exchange, and it changes hands. And lastly, while the REIT regulation requires the mandatory listing of units, the INVIT regulation has really progressed to allow both listed as well as unlisted INVITs. So our firm has leadership paper around REIT INVIT, which is also available on our website. And what I've done here, on this slide, is provide a very broad framework and its associated taxes, for information. So a typical REIT INVIT basically is nothing but a trust which is floated by a sponsor. These sponsors are the sponsors are basically the owners of the real estate and infrastructure assets, which generally or typically are housed in project subsidiaries. So what the sponsor does is, sponsor typically transfers its SPV shares to the trust against receiving the trust units. Now the trust is then listed on the stock exchange, and the investors acquire units in this REIT INVITs either through primary or secondary mechanism. As I said, for INVITs, it is also allowed to do private placement and remain unlisted. Now, there are different ways in which a real estate asset may be held by trust. So it can either be directly held, so trust owning directly the real estate asset, or it can be held through a single or dual tier SPVs. So in terms of taxation, the current tax law allows tax neutrality to a share to unit swap transaction between the sponsor and the trust. And this means that any other form of transfers, namely, any direct transfer of, real estate asset to the trust is basically not tax neutral. Also, while choosing the structure, one also have to be mindful of the stamp duty aspect, because a stamp duty is generally lower in case, when you transfer shares, as against a case when you look to transfer, real estate. With respect to taxation on, other streams of income, a REIT INVIT trust is a pass-through entity. However, if we, go into the nitty-gritties of the law, such pass-through is for, select pieces of passive incomes. So typically, any dividend or interest income that, this REIT INVIT may receive from SEBI, or a rental income, which it is directly earning from the asset which is parked in the trust. Both of them are basically treated as tax exempt in the hands of the trust. Now, any other income from transfer of SPV shares applicable rates, and generally, other than capital gains, the other end gets taxed at maximum marginal rates. Now, a REIT INVIT is required to distribute 90% of its income to its unit holders. So when it comes to if any distribution of incomes, if this incomes which have in the hands of trust, then the same becomes taxable in the hands of the shareholders. However, any income which has not suffered taxes at the trust level, which has already suffered taxes at the trust level, tax exempt in the hands would definitely be. Basically, the logic of the framework is simple. There should not be any dual taxation. With that, we move to the final topic of discussion, that is select stake enhancement, for the promoters. And this is primarily the focus is, basically on the listed companies. So if I were to, just provide some insight. So for any promoter groups or companies who are, basically sitting on a cash pile, the market meltdown basically offers an opportunity to improve the stakes in the companies. Now, we already spoke about, the share buyback mechanism, but now we can, look to discuss some other opportunities. So the first one, which I'll try to discuss is, the voluntary delisting process. Now, we already mentioned earlier about, Vedanta's announcement of delisting. So a voluntary delisting of a listed company is governed by SEBI delisting regulations of 2009. The chart, the flow chart which is given here depicts the typical delisting process. Now, the flow chart is as such, absolutely self-explanatory, but there are a few critical items in a delisting process which which I would definitely like to highlight. So the first aspect is the approval from the shareholders to initiate this process. So under the law, a delisting process can be initiated only if it is approved by at least 2/3 of the public shareholders who are present and voting on the delisting regulation. In other words, the vote cast in favor of the delisting regulation should be at least double the vote cast which is held against it. Now, if this majority is not achieved, then delisting cannot be pursued. And once this resolution is passed, then it remains valid for only 1 year. So within this 1 year, the promoter and the company has to definitely, complete and close the delisting process. The moment, it passes 1 year, then again there would be, a requirement of taking another, fresh shareholders approval and requiring to meet, the same norms of, two-third majority. The other critical aspect of delisting, voluntary delisting, is the price discovery mechanism. Now, the regulations require the price discovery to be done, through reverse book building process, and this mechanism effectively requires the public shareholders to tender their shares while also quoting the price at which they would want to sell. So what happens is, when they tender their shares this way, the merchant banker would basically collate all the offers and group it in various baskets according to, the pricing, pricing tendered, and the price at which maximum number of shares get offered, it becomes the discovered price. So that is the price at which the promoter or, the person who has floated the delisting process is required to, buy. Now, while, one may have reached a discovered price, but it is not mandatory that, the promoter or that acquirer has to compulsorily accept it. So while, he can always decide whether he wants to pursue further. If he pursues further, then he has to definitely, pay this discovered price to offer all the tendered shares, as well as, any acquisitions going forward from other shareholders. Or other thing is, he can also simply reject it, and he can, basically cut down the process. Now, before, you get into price discovery mechanism, there is also a floor price which is required to be stated, in the offer, and this floor price is, as per the regulation, has to be at least the higher of the preceding 26 weeks high low or the preceding 2 weeks high low of the closing price that is quoted on the stock exchange. And this should be, preceding the date on which board meeting is held, which approves this, delisting process. So I may also say, just caution that if you see the entire chain, there is a requirement for also a board meeting as well as a shareholders meeting. We spoke earlier about the shareholders meeting, but when we come to this floor price, it is basically linked to the date of the board meeting. So when this, when the board approves the delisting, from that date you discover the price for, discover the price to be stated as, the floor price. One of the other critical element of delisting is, for it to become successful, the promoter is required to acquire at least 90% of the issued capital. So if you were to ask me, the actual criteria under the regulation is either the higher of 90% of the issued capital, or whatever is the existing stake which is held by the promoter plus 50% of the offer size. So whichever is higher, becomes basically the mandatory number of share or mandatory stake that has to be reached by the promoter. If this process fails to achieve this stake, then basically delisting process itself fails. It cannot happen. One other critical item of voluntary delisting is, promoter cannot pursue voluntary delisting if it has sold any of its equity in the preceding 6 months before the delisting process. So this is very critical, and to be adhered if someone wants to, pursue delisting. It may also be noted that, say a promoter had a successful delisting process, but through the process he couldn't manage to, acquire 100% stake in, the listed company. So there still exist certain, minority stakeholders. Now, the still has to, keep this offer open. So it's not like now this minority stakeholders will get permanently stuck up. They still have a chance to exit the company, because the promoter is required to keep the same offer open for at least 1 year, even following the process closure. So, while this is one window available for exit, but even say if this also fails, then companies and promoters also, delisted companies also resort to other mechanisms and solutions to, exit the minority shareholders. So the next one is basically a very important proposal of allowing, delisting through NCLT route, which was floated by SEBI. So SEBI had, recently issued a consultation paper for public comments, where they have proposed to allow listing of an entity using NCLT circumstances. So this consultation paper typically covers, the situation which is, given on the extreme left of the slide. So say there is a parent, which is a listed company, and it has a subsidiary, which too is a listed company. Now there can be commercial reasons for parent and subsidiary to separately operate. However, in view of separate listing of parent and sub, the parent shares are always suffering a holding company discount. So such discount may, one can always, dilute such discount if, say, parent had 100% control, that subsidiary. So what, SEBI is proposing to do through the what SEBI has proposed to the consultation paper is allow delisting of the subsidiary through the NCLT process. So what both the listed parent and will float a capital reorganization. Listed parent will offer its own shares to the share, acquiring shares. So shareholders of subsidiary will transfer their shares to the parent, and parent will basically issue shares to the public shareholders. All this, however, is happening through NCLT scheme. Now, if this scheme, so the consultation paper says that if the scheme is properly implemented using all the procedures of 230, 232, then three objectives can be achieved. Number one, the subsidiary becomes 100% held by the parent. Number two, it gets delisted over the stock exchange. And number three, the public shareholders of subsidiary which continue to remain. Definitely which needs to be the tax before you put such kind of So first of the tax issue, if I were to cite, which you so this NCLT scheme as such is the law presently only exempts a transaction of merger or demerger under the NCLT process. So this particular share swap what we are talking is currently not exempt under the law, and therefore if the same were to apply as it is, then public shareholders will have to definitely cough out taxes on this share swap. So if you want to have this initiative to succeed, then this tax neutrality or deferment on similar lines as it exists in case of REIT INVIT has to be introduced in the tax law. If this doesn't happen, then definitely public shareholders would become mindful that they will need to cough out taxes, and they may have tax leakage while the scheme doesn't offer any cash to them. The other issue, if I were to talk about, is the holding period and tax basis of the parent shares. Now, it would be definitely prudent that the tax law is also amended so as to allow rollover of the earlier holding period and tax basis on the share swap transaction for the new shareholders. At present, such kind of rollover is only allowed on share swaps which have been undertaken through mergers and demergers. So overall, if we were to sum up, it's a very good initiative by SEBI, but definitely government needs to address the tax aspects for it to really become successful. Yeah. The next is the case of selective delisting of identified business. This slide talks about something which has practically also got implemented by some of the known names like Wipro, Sterlite, etc. So what I'm laying down is basically the concept, and how through which you can you really need not delist the entire company, but you can only delist the select business. So just take the example, say there is a listed company, which is given on the left side of the slide. Say there is a listed company which has two business segments, B1 and B2. Say the COVID-19 crisis is likely to impact B2 far more than B1. Also, the business of B1 has got selective investor acceptance, and so is the case for the business of B2. So while the promoters want to continue B2 as they see a good potential of remaining invested, however, the current losses or the lack of appetite for B2 is also casting a shadow on the listco's valuation. So B1 is not getting valued as per its intrinsic value, and it's getting overshadowed by B2. Now, what is the answer to this? The answer to this is simple: selective delisting of business, namely selective delisting of B2. So what happens here is the promoter basically sets up a new co, and they capitalize it with the requisite equity and funding. The business undertaking of B2 is then demerged into NewCo. Now, in consideration, NewCo, instead of equity, can consider issuing only redeemable preference shares to the shareholder. This is something which is allowed under the law. Preference core will have to be fairly determined, because here we are looking to give exit to the public shareholders. So the valuation definitely becomes very critical out here, and there has to be independent valuations which has to be kept on hand to justify the value. And finally, post the demerger, all this redeemable preference shares basically are redeemed by once these steps are fully executed, you will get what you see on the right hand side of the slide. That is, you have two companies, one which is holding B1 business, and now one it is holding B1 business. It is absolutely listed, and the USP is that now this listed entity will reflect the true intrinsic value of B1. So there is no overshadow of B2 which will now jeopardize the valuation. And on the other hand, B2 remains under the focus of promoters, and because now they don't have any public intervention, they can use their own means to infuse funds or expand this business. Yeah. So finally, we come to a couple of other mechanisms that have also been allowed under the law for promoters to improve their stake in the listco. The first one is the creeping acquisition window available under SEBI takeover regulations. Now, this window is relevant for any material shareholder who already holds 25% stake in the company and is wanting to progressively improve his stake without causing any open offer. So the takeover regulations allow such acquirer to acquire up to 5% stake from the open market in a financial year. Now, such secondary acquisition, however, entails certain disclosures, but then using this channel, there can always be an improvement of 5% stake year on year, by the promoter or the acquirer. The creeping acquisition window is available acquire the stake anywhere between 25 to 75%. So long as you are adhering to the 5% limit within a single year, anywhere you may be with respect to your stake level in the company, anything between 25 to 75, you can use this channel, and you can use it without really triggering any open offer. The other window that is reflected on the slide is acquisition through preferential allotment. Now, unlike the creeping acquisition, which is strictly governed by the ruling market price at the time when a promoter wants to make purchase, the preferential allotment has minimum pricing guidelines applicable under SEBI ICDR regulations. So primarily, there is a de minimis pricing guideline which is laid down under SEBI ICDR regs, and the formula is almost similar, is actually similar to what we discussed in delisting, namely the previous 26-week high low or the preceding 2 weeks high low before you look to make this allotment. Now while we talk about preferential allotment, I may also caution that open offer obligation of takeover regulations also apply in preferential allotment. So if any subscriber acquires a subscriber who already holds 25% stake and acquires through preferential allotment anything in excess of 5% stake, he would still have an open offer obligation. So an open offer will be triggered. Now it would be there is one exception which has been recently carved out by SEBI in their recent notification. Also, I'm sorry, this is just a consultation paper which SEBI recently floated. So this was with respect to distress listed companies. So in this consultation paper, SEBI has mooted that if any preferential allotment is required for a distress listed company, and even if say such allotment is breaching the takeover code, it will still not trigger any open offer for the subscriber. So this is one leeway which is available. Otherwise, even the preferential allotment, only distinction between preferential allotment and a creeping acquisition is primary and secondary nature of transaction. One more valuable or critical aspect of preferential allotment that I may cite is that a promoter cannot undertake any preferential allotment or acquire shares under preferential allotment if he has any part of his existing stake in the preceding 6 months before he makes the allotment. So this is one vital point which has to be noted before this preferential allotment can be pursued. So primarily that's it from my end for today's session. But before we move to the Q&A, I may want to put some closing remarks. So let me just say that apart from what we have covered today, there could always be various other purposes for which an effective structuring can help an organization to become more efficient or save cash. For example, there could be restructuring to gain cost efficiencies, or restructuring for tax efficiencies, or business consolidation, or say eliminating non-core businesses, etc., etc. This list could be endless. However, to be amply clear, a range of complex tax and regulatory issues must be navigated to successfully complete a business restructuring. Every restructuring is different and calls for a customized solution. Such solution can be derived only when there is a detailed analysis undertaken of underlying facts or business dynamics, the scales of the companies which looks to take restructuring, or its geographies. So we at RBSA now have a well-experienced team and dedicated transaction tax professionals who can holistically support for undertaking any of this structuring endeavors. So thank you very much for your patience, and would be happy to address the Q&A. So over to you, Chetan.
Thank you, Ravi. Thank you, for bringing out all the concepts in a very simplistic way. We are running out of time. It's 5:05, but if possible, we'll just take a couple of questions. First of all, I would let's like to apologize because there is one question which says that he was facing a lot of connectivity issues and voice was breaking. So our apologies for this. Ravi, if I can just take a couple of questions and just see if we are able to wrap it up as soon as possible. That whether a listed company can undertake buyback under SEBI buyback regulations during the pendency of a scheme under the Companies Act.
Chetan, sorry, your voice was breaking, but if I have understood this question right, what you are asking is, can a listed company undertake buyback while it is undergoing a scheme of merger demerger? So, well, my answer is that technically, SEBI buyback regulations specifically restrict a company from undertaking any buyback when it has a scheme pending with NCLT. However, there are powers granted to SEBI under the same regulations, whereby it can make exceptions to this restriction. So if I can recollect an example which had happened recently, as less as last year, was the case of Wipro. This was the case where the regulator made an exception. So Wipro was undergoing a scheme of merger where it was looking to consolidate 3 of its wholly owned subsidiaries into itself. Now, since there was no share issuance by Wipro involved in the scheme, the regulator basically granted them the leeway to undertake a buyback even while this scheme was involved. Yeah.
Another, whether a bonus NCDs can be issued only through the scheme of arrangements, or there are some other available options.
Okay, so what you are asking is whether a bonus NCD can be issued only through the scheme of arrangements, or they can also be privately issued. So here again, if our focus is if our focus is strictly on bonus NCDs, then company law as such technically doesn't contain any specific provisions which allow a company to issue bonus NCDs. So even if we take the bonus issuance of bonus provisions of company law, they are only referring to shares. So the shares can be equity shares or preference shares, but they are silent on this instrument of debentures. If we also look at the dividend provisions, which also explicitly talk about utilization of reserves for issuing bonus shares, here also the restriction has only the talk has only been around shares. So they have not spoken about debentures. So where there is no explicit provision, the only window that is available for pursuing that option is the NCLT route under 230 to 230. If I recollect, even this RBI regulations also, when they around this listed NCDs when they came in 2013, RBI has also specifically cited that the issuance of listed NCD can only happen through NCLT route. So that's my take would be that bonus NCD should be undertaken through a scheme.
Okay. So I'll take up the last question, Ravi. This is relating to capital reduction mechanism. So it says, can a company use capital reduction mechanism to provide exit to certain select group of shareholders? And second, can a company undertake capital reduction without giving any consideration to the shareholders?
Okay, sorry. Again, I think there is some.
So the first question is,
voice breaking.
can a company use capital reduction mechanism to provide exit to certain select group of shareholders?
Sorry, Chetan, I lost you. But if I understand you right, are you asking me that can a company undertake capital reduction to give exit to select shareholders?
To select group of shareholders.
Yeah. So if that is the question, then my answer is yes. selective capital reduction has been allowed under the law, and it has also been practically implemented. There are past precedences also. Take the case of Sandvik Asia or Cadbury's, or Reckitt and Cadbury's and Reckitt Benckiser. So long as this selective cap reduction process is approved by requisite majority of exiting shareholders and is also not detrimental in the interest of creditors, it can definitely be pursued. And I think, what was the other question?
The second was, related to capital reduction only. Can a company undertake capital reduction without paying any consideration to its shareholders?
So I think what you're asking me is, can a company undertake capital reduction without paying any consideration to shareholders? So my answer is yes. Generally, capital reduction, without consideration, is pursued in cases where a company has negative reserves in their balance sheet. So generally, we have seen that company use this mechanism where they have to rationalize their balance sheet in order to offset the losses against the capital. So those losses which are not represented by assets of the company, they are then neutralized by resorting to this capital reduction process. Having said that, there have also been instances where companies have filed schemes with NCLT. These companies don't have any losses, but they look to do capital reduction without paying any consideration. Now, one practical instance which I had seen last year is of Ansa Deco Glass, if I recollect the name clearly. Now, this company had tried to pursue a scheme where they had profits, but they still wanted to do capital reduction without paying any consideration. Now, if I recollect right, the scheme had been rejected by the authorities. Now, somewhere frankly, the law doesn't prohibit it, but this is what had practically happened. So my conclusion would be that one has to practically gauge whether the authorities of the place where you're filing this scheme are are going to approve such scheme, and if you have the comfort, then go ahead and do the scheme.
Okay.
Yeah.
So I think we are really running out of time. So I would like to thank all the participants for their patient hearing. There are few questions which I know who has a question, and we will speak to them offline, and few of them we will send emails so that at least we are able to answer to each one properly. And we trust that you found this session very useful and encouraging. We are planning to have further knowledge sharing sessions in the coming weeks, and we'll be sending all the details to you. So please do attend those. And once again, a very big thank you from the RBSA team. And stay safe, stay peaceful, and God bless us all. Thank you very much. Bye.
Thank you very much. Thank you very much. Bye.